Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, October 10th, 2022. I'm going to I am going to record this. I have no problem recording on my PC. We have power back, as I mentioned, I think as of Friday, and that's nice. But still don't have internet access at home, high-speed internet, so in this area, at least where I'm at. And so normally my backup has always been just simply tether off the cell phone and tether into the PC. But we've had the storm took out a lot of the towers in this area, and they've had temporary towers. And I don't know if it's the capacity of those or whatever reason the bandwidth is being throttled, meaning my internet connection is extremely slow. It even takes me instead of sometimes 20 minutes or so to whip up a post with some charts and commentary. It can take me over an hour just to get the posts out to you that I've been doing now, waiting for uploads. Uploads fail. So I'm going to give it a shot here. I'm going to record this video, and again, you may be getting it later today if the upload finally completes. I have no idea. I haven't tried to upload a video yet because it's tough enough to upload chart images. All right. But I've been dying to talk about the charts. I get little bits out to you here and there, updates on gold here, the stock market there. First, let me start off that nothing's changed since before the storm. The hurricane hit on the 28th, and I had to evacuate. Was it that day or the day before? And if you look at where we're at, here's SPY. We're about exactly where we were back then. So you really, and again, not much has changed in my outlook, and that's why I haven't killed myself getting out more frequent updates. There we are. This green candle right here is the 28th, and here we are today. So we had a little up and a little back down. Market seems to go nowhere. Can't really get out of its own way. And I want to talk on a lot of stuff here. So we still have. Let me start out by saying the risks right now are, a few weeks back I said they were unilateral or, skewed to the downside. The risk reward was more favorable to being short. They are shifting over to more of bilateral risk. And what I mean by that is, well, you do have these divergences, and I've talked about all you need is a spark, a proper catalyst. The markets seem to can't catch a bid here, but I still continue to expect some type of pivot from the Fed, whether it's cutting back on the quantitative tightening, or just whispers that they may slow the rate of increase on the rate hikes down, something to that extent. The markets are just hanging on that. It appears, waiting for that some type of signal that the Fed may, not pull a 180 pivot. That's not going to happen. They've already have a credibility issue to pull a 180 pivot. In other words, a rate hike. I'm sorry, a rate cut instead of another rate hike would be just, I think, probably catastrophic for the market. People, those that still are clinging to any little faith that the Fed knows what they're doing, will have probably abandoned that. And so again, for that reason alone, the credibility issue that the Fed has. I don't expect a full pivot anytime soon. So the reason I talk about risks, and I still favor the downside scenario. I still favor my fourth target being hit, but I'm ready to pivot myself, position wise when needed. And I'm still running that hedged portfolio. I like, I've got some long positions in the traditional risk off assets. Treasury bonds continue to trade in line with the stock market, which is unusual. Usually one goes up, the other goes down, and I'll get to treasuries in a second. I'm just going to focus on the stock market, treasury bonds, maybe touch on commodities briefly, because that certainly affects what the Fed will do. So you look at the most important things here. We're on a daily chart. Again, nothing's changed since I went partially offline over a week ago now for the storm. Well, that's where we're at. We still have that positive divergence. When you go out to the weekly chart, we're still at, I'll have to pause this. These charts load slow. That one came up quick. We're still at that long-term first target from this. That was from back here in the big, but that was before the Fed. The S&P 500 even topped, and so that was hit almost to the button there with positive divergence. So, from a technical perspective, again, as gloom and doom as things seem out there, and they are. I think the macro is very poor right now. I believe things are going to get a lot worse before they get better in the economy, and I do still think we're going lower. But again, if the Fed comes out with anything that causes even and that's all it would be a short covering rally, bear market rally. I'd look to short into, but with these divergences, it could has the potential to carry pretty high. So the takeaway is just don't get married to your positioning. If you've shorted this thing from the top, we're still right off the lows right now, and I'm saying, the bear market lows, so you're still very profitable there. And, my main focus is on the Qs. I'm going to jump over to that real quick. So we go to QQQ. That's not it. One more Q. There it is. Okay, so the story of QQQ on the weekly, which is really, this is my swing or trend. This is you can look at it from different perspective. Long-term perspective, the trend trader, the typical swing trader, will swing this down, and trying to game this bear market. And so far, we hit the first, second, and third target. We hit the third target there. We traded that bear market rally, got short again, and we're back at it. And remember, a target is a level almost always, sometimes it could be a Fibonacci retracement level or some gap I'm looking at, but and even that's support. A gap is. In this case, it was a price support, and as I like to say, support is support, total unless broken. So right now you have basically a test of the previous low. We've been testing it for 3 weeks. So say what you want, you can't declare victory for the bulls or the bears yet. Because nobody's moved it away from this level. The one that wins, bulls or bears, bulls can do this, they win. If bears can do that, they win. I still favor that, but again, the right spark or catalyst, and I think it's most likely going to have to come from the Fed, could give us that, but I still favor this. And let me talk on that. So from a pure technical perspective, you guys, if you followed me for a while, you know me, divergences are a very big part of my trading. They're not the be-all end-all, but they're pretty, carry a heavy weighting for me. And so you have on the weekly chart positive divergence on QQQ and SPY on those weekly charts because we made a slightly lower low and we're still making higher highs. It is what I call unconfirmed divergence, meaning we need to make a bullish crossover here on this PPO to give you what I call confirmed divergence because that'll put in that higher low. But right now, that's there. SPY has it. You go down on the daily chart, you have the same. You also have positive divergence. It's really the same divergence lines like that. So there's that potential. Now let me show you something. Okay, so why, Randy, if you love these divergent lows, and that's usually where you cover your shorts and go long, like I did back here based on the 60-minute and the fact T3 was hit for the first time. Well, a couple things. Number one, when I have multiple price targets, there are multiple targets because each target is a level I expect a reaction upon the initial tag. So T1 was hit there. There's your bounce. You hit it again, bounced, a couple of nice tradable bounces. These are all in the double digits. T2, we kind of consolidate around it. This was a reaction. I define a reaction as either on the downside when you're falling to support. A reaction is, in my opinion, what I define it as either a bounce off that level or a consolidation because you're falling and you stop. Use the analogy of throwing a tennis ball into a wall. It's going to bounce, right? And that's the bounce off support. Or you throw a hacky sack, a little bean bag full of sand, a little bag. It's going to hit the wall and stop. And that's also a reaction because you're moving forward and then you stop. So that's that. And then this one we had a nice bounce. And again, what I say is it's usually that initial reaction, you're good to game a bounce. Afterwards, if you are going to go to T4, well, you could bounce again. You could bounce several times. But ultimately, if I'm maintaining a target, it means I think that level will go. And being that we already had a nice bounce off there, I'm still leaning towards that. That was the initial reaction. That's the one I gamed. Right now I'm short before the storm. I had stops. I actually, I didn't have any cell service for a couple days after the hurricane, and then it was very spotty. And I was, pleasantly surprised. I actually made a good amount of money because I left just like I do, and if it's over the weekend or whenever, if I go on vacation, if I don't close out positions, if I believe in my position, I just walk away with an OCO. One cancels the other order, and that's on a short trade like this. It has a stop loss on the upside if we go up too high above levels, and I'll maybe stagger those stops, scale out, and on the downside it's a price target. So but let me show you something. So okay, so we're going to talk about these divergences. Well, let's go back here. Remember, we're in a bear market, and that's where a lot of times I'll override. I will allow myself to have biases if I can make a strong enough case to be short. or to be long. I can, let's call it confirmation bias if you want, but I am cognizant of what I'm doing, but I will dismiss sometimes bullish developments, bullish technicals, breakouts of patterns in a bear market, because that's what it is. And in a bear market, let me show you. Go back to 2008 here. Let's see if that's the right board. I might have had it on SPY. I've talked about this in previous videos as well. Okay, yeah, I have it marked up on SPY. So here's the S&P 500. I'm going to just tighten it up here so you can see it in the video. And this was the last bear market right here. Let me just show you one thing. So where are we at on the SPY, on the S&P 500 broad market? I'm going to grab this little line right here, right? And I'm measuring down to where we are today. Or that recent low. Let's just hit that low. 25% drop over 8.7 months. Right now we're 9 months into this bear market, okay? It started right about the beginning of the year, so it's easy math. So we're 10 months by that metric. So 9-10 months into the bear market, and that was about a 25% drop. Now we're going to go back to that previous level I showed you a minute ago. We'll go back to 2008, because to me that was the last bear market. Not COVID, not that drop. I believe that, to me, that was a correction. Even though it was a 36% drop in the S&P, it was just a correction in an ongoing bull market. We are now in a bear market. This was our last bear market here, 2007, October 2007 down to March 09. And so if you look at that back then, I'm going to grab the line. Let's see where we were about the same period into it. So here's right about here. Yeah, there it is. You can see the pop-up box again on the lower left, the bottom of that pop-up box on the left. That's about 9 months into it. We were right here, and we were about at that low 24% down. So almost mirrored. And I know I have said in the past, and I did use the parallels early on, especially the back test of the 200-day, and I said this bear market will play out. I believe ultimately it's going to play out a lot different. But right now we still have a lot of parallels. So both in the time and scope. The scope meaning a roughly 25% drop, about 9-10 months into that bear market. And look what we had here. See the red? We had, you got it, just beautiful positive divergence. So you had probably a lot of bulls licking their chops saying, ooh, positive divergence, we've already dropped 25%, bear market's over. That's when the bottom fell out, and that's when these divergences failed to play out for anything more than a very minor bounce that got sold into. So there it is. So this is why, again, in a bear market or a primary bear trend, bullish signals, bullish developments tend to either play out for a very small move to the upside, or they'll play out not at all. And bearish developments tend to play out, bear flags tend to play out a lot more often than bull flags in a bear market, and vice versa in a bull market, right? Okay, so that's that. Just want to point that out. Okay, so let's just take it down, finish up on the charts, quick view. I like multiple time frames, 60-minute chart. This is everything that's been covered lately. Here's our primary downtrend line on the 60. There was most recently, again, this is just before, the storm was back here. We had this divergent low, bullish falling wedge. We broke out, and we put in this bearish rising wedge right here. See, you had this big bullish falling wedge. In a bull market, a big, strong positive divergence, that's usually good for the move to new highs and beyond. In a bear market, all it played out for is this little pop, gap up, squeezed out a lot of shorts, rallied up the bulls because it was one of the biggest moves in like 2 years, whatever the headline said, this rally off the recent lows, and all it was is a bear market rally. It's been faded 100% and then some. Now we've just undercut the low, and there was a breakdown in that gap down. See, this is what bear markets are vicious if you don't know how to trade them. They're vicious to bulls and bears alike if you if you can't almost anticipate or expect these kind of things. This gap up. Gaps trap. They trap short sellers, and they deny longs an objective entry because the long wanted to see a breakout right above the trend line they could get in early, and they had to decide to chase there. And the longs probably took that, especially on the heels of that big move. Long side traders, shorts got out, squeezed out, and that sets the stage for the next move down, because those longs then got trapped on this gap down and said, oh, I'll just hold, and in the pain, they're feeling more and more pain, so they're stopping out, selling out. And then shorts maybe didn't want to chase that gap down, and so you have lower short interest, and that's the fuel needed. When you have a high short interest, the market can only drop so much because you have a lot of shorts taking profit on those drops. And when you have little short interest, there's really no buyers. Remember, I always say short sellers are the only guaranteed buyers in the stock market. Bulls, those are bullish, only like to go long. Well, they might plan to buy, but guess what? They don't have to buy. You short a stock, you must buy to cover to close that position at some point. Okay, so that's how things look pretty much on the equity markets. We just continue to move lower. The market can't get you bid. The divergences are still in place on the daily and weekly. Yes, it's a marginal new low today in QQQ, but not much more. So for all intents and purposes, we're still at this moment still testing that support level. Since we're not, it's only intraday. We're below it now. We could close back on it or near it. On a 268 point price level. It takes, what is, 10% is 26, almost $27 move. So, you'd have to, 1% is small. So you could give it a little margin error. Again, I think we're going down that way, but we'll have to react. And the thing is, let's go now to treasuries because that's a big one. This move up in treasuries is relentless. I've warned of problems with pension funds in the U.S. for a while. It's already happening. They're blowing up in the U.K. Government's stepping in now with all kinds of emergency programs. Mark my words, that's happening here as well. You're just not hearing about it yet. Maybe for different reasons that had to do with their versions of our US Treasury bonds and the regulators pushing. If you've read up, if not, read up about that, but you'll see the same here. And this is TYX, the 30-year Treasury bond yield. We still need, I told you I plan to add to my Treasury positions. I actually had a few stops as I was doing the video. I don't know if you saw a little pop-up down here. I had 2 tranches of stops hit on ZB, so I have a little less than I had before. Just proper money management, having those stops in place, and they've been there for a while. They just got hit today, but I'll look about re-entering. I'll see that in a second. There's a minor uptrend line right there that I think is going to come into play. This is a weekly chart, but again, the big buy signal will come if and when this uptrend, this bearish rising wedge breaks, and I promise you it will. I can't make that promise, but sooner than later it will, because the whole financial system will break. The U.S. will break. This is how we raise money. We cannot afford if the continued rate of ascent. If Treasury yields keep going up, it makes our borrowing costs very expensive, and it wreaks havoc on hedge funds, mostly pension plans that have a lot of treasury bond holdings, other things like that. This has always been one of the go-to risk assets. It affects global trade. It affects, interest rates as a whole, especially have a big impact on smaller third world countries that owe a lot of money back in US dollars. So same thing with the rising dollar. It's unsustainable, this trend. So at best, it can maybe level out, but things are going to break. Things are starting to break around the world. So, you're probably reading about that here and there in the paper, and it's going to be more and more. You can only go up so much so fast after a decade of artificially low interest rates. It's just not healthy. So this is TLT. That's a weekly, daily. Remember, the buy signal, there hasn't been a buy signal yet. We're still in that price channel, or at least the primary downtrend line. So for weeks, if not months now, I've been saying this is where your buy signal comes, and it will come. You still have the positive divergence, and if the catalyst is both technical, meaning the breakout, and fundamental, meaning anything, like I said, I suspect the Fed will come out and just say they're going to slow the rate of quantitative tightening. That's my best guess. Doesn't matter, whatever it is. And even if there is no fundamental cause initially assigned, technicals always for me first and foremost. But if you get that, and it could be a violent short covering rally in treasury bonds, an explosive rally. So that's why, I have a little less position today. I'm going to have to, I'll look at it. Look, here's ZB, basically. So yeah, I must have raised stops along the way after this low. Got popped out. But there's the trend line ZB needs to take out right here. Downtrend line. I have a regular one right there with a false breakout, and then the BOD comes in, catches 1, 2. There's a little spike reaction there, and it comes in and then catches that one. So this is called my BOD, or benefit of the doubt trend line. This one will probably do the trick of breakout above the lower trend line, but then that one, big, first resistance, second, third, and so forth and so on. And again, overall, that, even though treasuries have been still trading in line with the stock market, I suspect that at some point soon, both of these are going to rally, but maybe treasuries first. And again, I'm viewing it as an indirect hedge. Right now, they're highly correlated. There was a little bit of time where they started to become decoupled, where treasuries are going up, and right now they're both down today together. Okay, to not make the video any longer than it has to be, I'm going to skip the put to call ratio measures. I'm just telling you, I haven't seen any signs. This bear market is a lot like the one in '08, '07, '09, where so far there's just a lot of non-believers. They're thinking it's going to be over soon, and I have not seen any of these signature signs of capitulated, selling climax capitulation. It's been an relatively orderly sell-off. We haven't had any lock limit down days on the stock futures or shutdowns, with the trading halts and all that, like we had back in '08. That usually comes. You'll know it. Like I refer to it as waterfall selling, and so that hasn't happened yet. So bear market rally coming soon or not? I still believe the bear market is far from over, at least in percentage term and in time too. But again, we'll see. All right, VIX. You guys remember last update I did on the VIX for the storm was we had a downtrend line here. That's a pretty big level, and an even bigger level right there, about 37.61 give or take. And so the VIX broke out above the primary downtrend line. You have quite a few reactions. The primary up there, and then several reactions along here. We had a breakout back test. We're holding above this uptrend line. We're successful as well. And if we can pop 30, we'll call it 38. If that happens, we're going to be in that hard selling mode, I believe. So just bottom line is this right now is a bit of a warning sign for the market, but unless we take out that level with conviction, it's still anybody's game. But just something to monitor is what I'm trying to say, and watch that level there. I've just lost internet connection. I don't know if you can hear little bells and things going off. That's one thing about this. Not only do I have a slow phone connection, I've talked to other people, it just randomly drops. Again, a lot of problems here with the cellular networks, but okay, data just reconnected so I can flip charts. All right, I just had to wait until the cell connection came back. All right, so it's not only the VIX, and that's a daily time frame. Here's how it looks on the weekly. This is a little cleaner. You can see that spike high. That's when COVID hit, that spike in the VIX. And there's the breakout right there. Not really impulsive yet, but a breakout. So take it on face value. If it fails, it fails. As of now, there's a breakout. Pops, there's that 36.72-ish level. Off to the races. And again, these are where bear markets have ended, the last two. If you want to call the 36% drop in the S&P a bear market, absolutely no problem there. That's what happened. There's where the VIX went, and there's where it went in 2008. So nowhere near there. So as much as people are singing the fear song and talking the fear talk, they ain't talking it with their money. They're not buying VIX. I'm sorry, they're not. The put to call ratio is not soaring to levels. It's certainly elevated. The VIX is certainly elevated, but not to levels that have marked that panic capitulation selling. So that's that. And it's not only the VIX. You have the VIX is the one of many volatility indexes. You have the VXN, which is the NASDAQ volatility index, and look at this. Look at this level right here. This is a resistance zone, big level. You have a lot of reactions at the bottom there, several spikes to the top of that level. That's your off to the races. That is get out of Dodge. If you're long, get into your shorts is about 44. And once the VIX takes that out, and it's also back testing this trend line. If it can recover that, that would be VXN, I'm sorry, the NASDAQ Volatility Index. That's just a long-term chart. So that one, and even Apple is so big, pretty much has its own zip code, or at least its own VIX. This is the VX APL. It's the CBOE Apple VIX. So it's just a VIX, a volatility index measured on put and call buying for Apple. Single company, because it is the largest component of the NASDAQ 100, largest component of the S&P 500, so it matters. Look at that level there. That's about where it gets, other than when you have that final meltdown You had a couple spikes there. These all came during corrections, but look, this is just a nice level. This has capped everything this year in Apple has been capped around this level here, about 49.75 up to about 52. We'll call it a zone. Get those spike highs. So these are the things you want to watch. All these volatility indexes break out. Market takes out the recent lows. We could get that final thrust down, and I suspect it'll be fast. Selling tends to beget more selling. It's a vicious cycle. Stops are hit on longs. Short sellers smell blood and jump in, blood in the water, and they pile in. And hedge funds, mutual funds get hit with forced redemptions. ETFs. That's how all that works. And last but not least is DJP. This has been for the last couple of years. There's many commodity tracking ETFs that track commodity indexes out there. This one is very broad based. It's not. A lot of the others are in my opinion, a little too top heavy on crude and natural gas. Although crude oil has one of the biggest impacts on inflation, but this one you can see is well rounded. You've got them all. Nat gas, gold, crude, WTI crude, Brent crude, soybeans, corn, copper, silver, gas oil futures, soybean oil. Everything in there, precious metals. I have a target here. We put in this divergent high. So this was that abatement of inflation. That gave us that was the catalyst for that initial rally, and then we started to get it up again. So again, commodities go up, inflation goes up. Then we had a bearish rising wedge. We broke down. So there will be an abatement of inflation somewhat. But look, bottom line is we're back to right now where we were. We're not seeing a big relief. We haven't fallen all the way to that target down there at $31. And so, we're not rocketing up anymore, but we're really not going down. And so therefore, I don't know how to parse or figure out what, just trade the charts right now. Where I'm going, I guess, guys, what I'm trying to say is if we saw over the last couple months, if this just did this, I would tell you then you're going to see some very rosy, or at least for the stock market, inflation data, as the numbers come out going forward. But we're not seeing that. Inflation is persistent. It may not be soaring as it was back here, but it's really it's not abating, and these prices are now pretty much ratcheted in, locked up. So I don't think we're ever going to see. We could see a deflationary spiral, and then again that all plays into the whole Treasury thing. Depending on how severe the recession is, I think it's just getting started. There's a lot more to go. Ultimately, the deflationary effects of a recession should bring down crude, other things. You've got a lot of cross currents. I don't need to tell you this. With Russia, OPEC Plus just getting together and agreeing on price cuts, production cuts, on oil. OPEC Plus includes Russia. That's OPEC with Russia in there, much to the chagrin of the Biden administration, who's just doing their dangdest to get oil prices down. How much more of the strategic petroleum reserves can you release? What point do we then have a risk the safety of our whole country? That oil was usually set aside for military purposes in time of war and all that. So anyways, it's a mess. So I just wanted to point out, here's what commodities have pretty much on balance. Again, this is a broad basket. Oil's still doing its thing, natural gas. But all right, you guys, the takeaway is no change in my outlook. Still looking for more downside. Still bearish. Still short. And if that changes, I'll let you know. But I think we're getting close to, especially if we see these lows that have held so far for the last few weeks, they clearly start to get taken out. Should be a flood of stop losses, and more important, forced margin selling. There's a lot of iron-fisted people out there that have heard years and years and years of the experts tell them it's all about time in the market, not timing. I used to be a stockbroker. That was one of the number one cliches. It's all about time in the market, not timing. Well, I have, for the last 20 years, my after leaving that behind, I make a living on timing the market, and I can tell you that timing the market is much more profitable than time in the market. And we've bear markets in recent years. Last one again, if you count on the page with me that 2008 or even COVID, call it, or the fourth quarter drop in 2018, you want to call those bear markets, they were over before you blinked. The drop in COVID from when the markets peaked in February, they bottomed in March, a month later, 6 weeks later. I think that whole bear market lasted, and then it exploded higher because of the Fed. Fourth quarter 18, yeah, it dropped for a few months, went up. 2007 to 2009, early '09 was just about I think an 18-month bear market, and this one I believe is going to be a whole lot different due to the fundamental landscape. But within it, there are going to be plenty of opportunities to trade rallies, some that may last months, and we've already seen that result in high double-digit gains. So we'll continue to time the market, or at least I will, to the best of my abilities going forward. All right, let me wrap it up here. This has been Randy Finney with Right Side of the Chart, and for whatever reason, if I cannot get this uploaded today, it could come out tomorrow, whenever. If it's still timely, I will then publish it. But if I can't get it uploaded for the next few days, well, you won't be hearing my voice right now because I won't publish it. All right, guys, have a great day.